Greetings, everybody. Welcome to Liberty Call. Today is Tuesday, December 6th, 2022. I always have to check the date. I look at it right before I start, and I always have to look back down just to make sure I don't say something stupid. So, again, hope everybody's having a great day out there. If it's your first time watching, give me some big old thumbs up, like, share, subscribes. I would greatly appreciate it. I'm sure there's folks out there in the interwebs who have questions about what's going on generally, about the economy and such. So, feel free to shoot me a message. My emails are right here on the screen, so you could send that anytime. Another not so friendly day in the markets. Looks like they pulled back from as bad as they were when I went out to go run some errands. That's why I'm a little bit late this afternoon. Had to go resupply the groceries and stuff, so I had to go run out late this afternoon and take care of that. So, all right, well, let's go ahead and look at the markets, see how they finished for the day. Dow Jones is down 1.03% or 350 points, closed at 33,596. S&P 500 down 1.44%, closed at 3941. NASDAQ down 2%, closed at 11,014. Small caps were down 1.53. The VIX again was up today. It was up 8 something yesterday. Today it was up 6.84%. It's currently at 2217. Canada was down 1.25. Brazil was down, Brazil was up 0.72. Mexico was up 0.44. Headed across the Atlantic, sea of red. Germany down 0.72. UK down 0.61. France down 0.14. The Euro Stoxx was down 0.44. Netherlands was down 0.47. Italy down 1.15. Switzerland down 0.76. And Portugal down 0.22. Both Russian exchanges in the red. MOEX finished down 0.55. RTSI down 1.58. And the Asian markets overnight, see some green there. Japan was up 0.24. Australia down 0.47. In China, the Shanghai basically flat at up 0.02. The SESE component up 0.67. China A50 up 1.03. DJ Shanghai flat at up 0.08. Hang Seng down 0.4. And the Taiwan weighted came in down 1.68. So it looks like the only positive markets were in the Asia markets overnight. Everything else looked pretty crap. Well, again, domestically here in the Americas, Brazil and Mexico were in the green too, but everything else was just awful. So again, not to be surprised. I mean, I've been saying for a while that this, bear market rally is going to run out of some steam. I've covered some articles that have basically reiterated that same point. But there is some good news out there. Oil's coming down in price. We're going to have an article talking about that in a minute. But also some bad news that our trade deficit is widening again. So that's not the best news that's out there. So, all right, well, let's go ahead and read through today's market recap. Dow wins in red as Fed fears wound tech. The Dow closed lower Tuesday as investor appetite for bullish bets remained sidelined by ongoing concerns that a higher for longer interest rate regime could tip the economy into a recession. Again, these folks can continue to try and talk our way out of recession over the next, they've been doing it they started raising rates, about 9 months ago? And even before that started, they were already talking about, when we lower rates, things are going to be so much better. And it's like, really? We haven't even got this fire under control, and y'all are already talking about what you're going to do with your Christmas gifts 2 years from now. So, it's kind of weird. All right. Big tech remained in the firing line, paced by a more than 6% decline in Meta platforms amid increased regulatory scrutiny. And Jake just ran off because I think the Amazon guy is here. So if you hear some barking, just ignore that. Alphabet, Apple, and Microsoft were down more than 2%. The Fed broadly expected to slow the pace of rate hikes to 0.5% at its next meeting. Next week, but its projections about the path of future rate hikes are likely to dominate investor attention. Recent economic data, including an upside surprise in service activity and a strong monthly jobs report, have stoked investor fears that the Fed's higher for longer rate regime may tip the economy into recession. I think I already said that earlier. Yeah, they reuse the same sentence there. Quote, the bottom line is that this wage-driven inflation isn't isn't an easy fix, end quote. Eric Ditton, president and managing director of the Wealth Alliance, told Investing.com's Yassine Ibrahim in a recent interview, quote, the only way the Fed's really going to get this pressure on wages down is to cause a recession, which they probably will, end quote. Energy stocks were dragged down lower by falling oil prices amid jitters about slowing global growth and worries about the oil demand outlook, even as China, the world's top energy importer, recently eased economically draining COVID restrictions. APA Corporation, Marathon Oil, and EOG Resources led the losses, with the latter closing nearly 5% lower. PepsiCo lost about 1% as media reports the firm is readying hundreds of job cuts at its North American snacks and beverage division, sparked jitters about slowing growth. Silvergate Capital, the heavily exposed lender to cryptocurrency firms, continued to rack up losses, falling more than 4%, even as Chief Executive Officer Alan Lane said the bank had ample liquidity to meet customer withdrawals following the collapse of crypto exchange FTX. In other news, Boeing Corporation is set to roll out its last 747 jet, marking the end of the aircraft's 50-year iconic reign as the company moves to produce more efficient jets. All right. So that's the news today. It seems like everybody's down because it looks like the Fed is going to continue to raise rates even more. But again, if you've been paying attention, until the interest rate is higher than the inflation rate, I don't think we're going to see a lot of slowdowns. But again, I could be wrong. Hey, Jake, nice you to come back and join us. All right, next up on the docket, oil ends near one-year low on worries over Fed and U.S. economy. Oil prices continue to tumble Tuesday, nearing a one-year low and losing some 7% on the week as fears mounted over the possibility of the Federal Reserve turning aggressive on interest rates again in the coming year, as U.S. economic data suggested unrelenting pressure on inflation. WTI crude for January delivery settled down $2.68 or 3.5% at $74.25 a barrel. It sank to $73.43 earlier, its lowest since December 27th. Week-to-week data, WTI was down 7.5%. London traded Brent crude for February was down $3.33 or 4% at $79.35. It hit a session low of $78.72 earlier, a bottom not seen since January 4th. Brent was down 7.3% on the week. The slide in crude prices came as traders appeared to embrace the notion that there would be no severe supply disruptions in the near term, despite the European Union's so-called ban on Russian oil and Moscow's noisy protests against the price cap on its crude by the West. Quote, it's all shadowboxing, if you ask me, what Russia and the EU are doing on the so-called ban and price cap on Russian oil, end quote, said John Kilduff, founding partner at New York energy hedge fund Again Capital. Quote, neither side is really doing anything to hurt the movement of oil in the market. It's all talk and no real action. In light of that, the market figures all is fine for now, despite Russia and OPEC trying to scare everyone with talk of a supply squeeze, end quote. The European Union officially stopped importing oil directly from Russia as of December 5th. Simultaneously, a price cap of $60 per barrel on Russian crude came into effect on Monday. Both measures are aimed at punishing Russia for its war against Ukraine and creating a cash crunch for Moscow, which relies heavily on earnings from oil and gas for spending in almost everything. Under the price cap, the non-EU nations importing seaborne Russian crude cannot get shipping, insurance, or reinsurance services from established Western companies in the business if they pay more than $60 a barrel. That could complicate the shipment of Russian crude priced above the cap, even to countries which are not part of the agreement. Russian Urals crude traded at around $67 a barrel on Friday. Excuse me. The Kremlin has vowed not to do business with any country that tries to apply a price cap on Russian oil, but industry experts said it might not be entirely possible for Moscow to escape Western shipping and financial services that were tied to the price cap. Kremlin spokesman Dmitry Peskov reiterated on Monday that Russia, quote, will not accept, end quote, any price cap on its oil and was analyzing how to respond. The West's action would destabilize global energy markets, but not affect Moscow's ability to sustain what calls its, quote, special military operation, end quote, in Ukraine, Peskov added. But other than talk so far, the Russians haven't done anything in retaliation. Again, my view on the whole Russia-Ukraine thing is this was a problem in a lot of ways created by NATO, the United States, and, pushing further east, pissing off the Russians. The Russians, poke back, and then everyone on NATO and the United States was like, oh my God, I can't believe they attacked us. It's like, really, folks? I mean, you poke the bear in the chest enough times, the bear's going to swipe back eventually. So not that they're right in invading a country. And frankly, I think the U.S. and NATO are happy to fight this war until the last Ukrainian is dead. But it doesn't seem real fair to those people there. Anyways, but could there be an energy crunch this winter? It kind of depends on the weather in Europe. If it gets really cold and they run through their supplies, we might see prices start to spike again. But it's too soon to tell right now. So just be nimble with your portfolios out there, folks. All right, last up, U.S. trade deficit widens as goods exports hit 7-month low. Remember we talked about why the GDP numbers look so good for Q3? Well, we were exporting a lot of oil, and that helped our numbers look fantastic. Well, we're no longer doing that since we've shut off the spigot to the Strategic Petroleum Reserve, and now we're seeing that sway back the other way. U.S. trade deficit widened sharply in October as slowing global demand and a strong dollar pushed goods exports to a 7-month low, suggesting that that trade could be a drag on economic growth this quarter if the trend persists. The report from the Commerce Department on Tuesday, which followed on the heels of a recent upbeat news on the economy ranging from consumer spending, the labor market, to the services industry, did not change perceptions that the economy had gotten off to a solid start in the fourth quarter. Quote, a rewidening in the trade balance will mechanically weigh on GDP growth for the fourth quarter, said Veronica Clark, an economist at Citigroup. Quote, however, this should be partly offset through strength in domestic demand, particularly in business investment, as real capital goods imports have jumped in the last few months, end quote. The trade deficit increased 5.4% to $78.2 billion. The second straight monthly widening in the trade gap was partly driven by a shift in pharmaceutical products trade, with exports of these goods falling sharply and imports surging. Quote, trade in pharmaceuticals was always notoriously volatile, and it's only gotten worse with big international shipments in both directions of COVID vaccines, end quote, said Paul Ashworth, chief North America economist at Capital Economics. Exports fell 0.7% to $256.6 billion, with good shipments dropping 2.1% to $176 billion, the lowest level since March. There were decreases in exports of international supplies, which largely reflected natural gas and other petroleum products. Crude oil exports, however, increased $1.6 billion. Exports of consumer goods fell, pulled down by a $2.2 billion drop in pharmaceutical products. Food exports rose, lifted by soybeans. Capital goods exports were the highest on record. Exports of services raced $1.8 billion to an all-time high of $80.6 billion, boosted by travel, transportation, and other business services. The dollar at one point this year had appreciated more than 11% against the currencies of the United States' main trade partners from the end of December 2021, the result of the Federal Reserve's fastest rate increase cycle since the 80s as it fights inflation. As of this month, the dollar was up 5.9%. on a trade-weighted basis from the end of 2021. So it's come back about halfway at this point. Dollar strength is making U.S. manufactured goods less competitive on global markets. Monetary policy tightening by global central banks is also eroding demand. Surveys from the ISM this month showed measures of manufacturing and services exports stuck in contraction territory in November. So, all right. So not so good news on the import-export business. I mean, again, we are importing their, goods and services and sending them our worthless dollars. So I don't know if that's necessarily the worst trade in the business, but there are people who fret over this on a regular basis. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there, and I'll talk to you guys next time. Adios.